4 undervalued dividend stocks under $100, and they're all near their 52-week lows with some nice upside. We're going to look at each company, historical performance, we'll look at their dividend safety, we'll run into their financial metrics, and as always, we'll run each one through the valuation model so we get to our intrinsic value, as well as seeing what Wall Street are forecasting over the next 12 months. So the first undervalued dividend stock we're looking at is Bristol Myers Squibb. Now this is down 26% over the last 12 months. As we see, it is trading right there towards its 52-week low. Now it has a nice starting yield of 4.6%, and we can see a forward P of under 8 there. In terms of the last 10 years, if you've been a shareholder, well, you would be up 6%. Now it doesn't include those dividends reinvested, but not a great return. We do also see its all-time high is sitting at $81 at the back end of 2022. Now, in terms of their dividend safety, we have a score here of 70. It looks to be safe. Market cap, $106 billion. It is a mega cap company. Now, in terms of the last recession, well, in fact, they maintained the dividend. They didn't increase it, but again, they didn't cut it. They had below average growth, negative 21%. Bear in mind, the average of the S&P was negative 12 during that period. But they did essentially outperform the S&P, negative 32, with the S&P coming in at negative 55. In terms of dividend growth, not too bad, plus 5.3% in December, just a few months ago. Now that is above the average we advocate on the channel of 4% or more, just to keep up in line with inflation. Over the last 5 years, it's 7%, looking fairly healthy. Over the last 20 years, they are just about keeping up at that 4% level. And when we take a look, we can see they have been increasing those dividends over the last 17 years, whilst paying a dividend for the last 53 without a reduction. Now, in terms of dividend yield theory, for those that are just joining us on this channel, it states the company is undervalued when the current yield sits above that 5-year average. 4.63 above 3.15. We have a double sign on today's episode, 7.6 on the forward P, below the 5-year average of 9. But do bear in mind, we don't look at any of these models in isolation, and we can see it is significantly lower than healthcare at 16.6. Now, in terms of looking at the free cash flow payout, we want to see below 60%, my personal blanket rule, below 50%, again, biotech industry specific. I mean, since 2018, it has been well below 50%, even 38% in 2023, expected to go lower in 2024, so no worries with that payout whatsoever. In terms of the free cash flow per share, as always, we do prefer looking at free cash flow information, as earnings can be susceptible to manipulation by management through accounting. And we do note the free cash flow has increased over the longer term. Actually, a very positive sign for a company that does manage to keep increasing it for the large part of the last 10 years. 2024 expected to go even higher to $7.33. Definitely a big plus. And in terms of looking at sales, 3 to 7% as the bare minimum. Now, they have struggled over the last 2 years, but prior to that, very strong increases nearly every single year. And when we look at it numerically for a 10-year time period, they have nearly tripled their top line from 16 billion to 45. We do want to point out, however, they would have diluted your position if you were a shareholder over the last 10 years, increasing those shares outstanding from 1.67 to 2.08. Now, in terms of the ROIC, double digits is what we want to see. They have managed that over the last 3 years, although we do note from 2014 to 2018, it was a much better period of the company in terms of reinvesting, allocating that capital. But again, still looking fairly positive, just something to keep an eye on given how far it has fallen. In terms of the margins, above 25% for biotechs, they haven't really managed to consistently hit that. The last few years, not too bad, maybe something you may want to keep an eye on and factor that into your margin of safety. Free cash flow margin since 2017 looking very strong, and it is pretty attractive for an investor to see that 28% in 2023. Finally, the net debt to EBITDA, the earnings before the interest, tax, depreciation and amortization. We can see here that 1.63 in 2023, expected about that in 2024. Now, we do want to see around 1.5 for biotech, so it has straddled around that over the last 4 years. Something maybe to consider, but it does look like the balance sheet and dividend does look to be safe. Remember, these are the numbers that essentially show the number of years it would take the company to pay off all of their debt net of cash on hand. Now, in terms of the valuation of BMI, remember, if you do enjoy the content, value is being provided. Smash that like button, hit that subscribe and bell button so you are continually notified of these videos as they drop. Now, typically on the channel, we do run through every single one of these models. For today's episode, let's jump straight into the intrinsic value. And for BMY today, it does sit at $64.53. Now, with the current price trading around $52, we are using a margin of safety. We start off with 10%, which we execute if we believe it meets three criteria: a wide moat, strong financial metrics, good forward-looking data. This will differ from investor to investor. We then move to 15%, essentially getting near the current trading price. And we can see it is pretty much a few cents shy, so we see a 20% MOS level based on our estimates and judgments in today's episode. In terms of Wall Street, well, their forecast, they see it at $61 or just over the next 12 months, signaling strong double-digit upside of 18%. And as always, do let us know your thoughts in the comments below as we go along with these stocks. The next undervalued dividend stock, it is one we haven't reviewed in such a long time. It is Universal Corporation, ticker symbol UVV. Now, it is in the tobacco industry. We do note the high yield of over 6%. Forward PE sitting around 9.5 and again trading towards the 52-week lows. Now, you would be down 4% over the last year. Over the last 10 years, you would also be down 5%. We do see it wasn't too long ago, in fact, where it was sitting at $67, so it has come down quite a way. So let's take a look at the metrics. Well, dividend safety, 60, borderline safe. Market cap, just over 1 billion, so it is a small cap company. In terms of the recessionary metrics, well, in fact, they increased it during the last recession. They had near enough average growth and they did near enough return, the same as the S&P, negative 48, slightly better than negative 55. In terms of growth, very poor in May, in my opinion. That is lower than inflation, which is a shame given the last 5 years was strong at 5% or 8%. Over the last 20 years, at a minimum, keeping up in line with inflation is positive, especially when you are locking in a nice yield. In terms of number of years, well, they are a dividend king. They have increased those dividends for 53 years. Very, very nice achievement. And in terms of dividend yield theory, we do get that sense of undervaluation. Looking at that yield, 6.34, it is above that 5-year average. And when we do compare it to the consumer staples at 20.2, we can note currently sitting around 9.5, so it is much lower than 20.2. In terms of looking at the free cash flow payout, what we can point out here is very, very inconsistent. The reason why we are about to show you when we do look at their free cash flow, it is very, very mixed. And typically for tobacco companies, we want to see 85% or lower. What we do know on the trailing 12 months, it does sit higher. So this is definitely something we would look to consider and factor in to our margin of safety, as this shows us that over the last 12 months, so the trailing 12 months, they were paying out more in dividends than they generated in free cash flow. In terms of the free cash flow, we do have it here very inconsistent. Over the last 10 years, 4 of those years was in fact negative. However, we do know on the trailing 12 months, we do see a positive sign of 256. In terms of sales growth, well, typical with this industry, you would expect it to be fairly low, in fact negative. We do see 5 of the last 10 years negative growth. More recent year, double digits at 22%, so that is strong. Probably the best tobacco company in terms of sales growth, with others reporting either negative or single-digit increases. And when we take a look at it numerically, we do see it go from 2.54 billion to 2.57, so very minimal growth and a lot of period where it was consistently decreasing. Now, they don't hold a lot of shares outstanding, but we can see they have been doing share buybacks, buying back a number of shares over the last 10 years. Effectively returning excess cash by giving you more control over the company. In terms of looking at the ROIC, it does slightly disappoint for a tobacco company. We want to see above 15%, but we do know that it is consistently around the 8 to 10% level. So as long as you are seeing consistency in this metric and other metrics aren't looking too bad, then that isn't the worst case scenario. In terms of the margins, we do know fairly low for a tobacco company, around 7 to 9%. Again, it is very consistent. And the free cash flow margin, no surprises here, given we did just look at the free cash flow per share, which was very, very different year on year, positive and then negative. So what about the net debt to EBITDA? Well, we can see here it has been increasing over the period at 3.1, hence why we do see that borderline safe score. So this is something we should definitely factor in when we do take a look at the valuation. So let's jump in, and don't forget you can grab a copy of this model if you want to get to both the intrinsic value as well as the acceptable buy price of companies in your own portfolio or those on your watch list by clicking on that pinned comment below. Margin of safety then, we start off with 10%, and we can see it is a buy up to $62, at 15% up to $58, at 20% up to $55, and at 25 near enough the current trading price. Not quite there yet, so we do see a 25 to 30% MOS level for UVV. Again, it is the tobacco industry. Different investors will hold a much higher margin of safety than others, so do let us know whether or not this company in this industry does entice you. In terms of Wall Street, well, they see some nice upside. They do believe, similar to Bristol Myers, this is a strong buy with double-digit upside. Their price target is $59 over the next 12 months, with a 17% upside associated with this stock. Now, don't forget also to sign up to our articles and newsletters completely free. We have just released a new one, so do click on that pinned comment below and you can grab yourself a copy and run through all of these, instant access and completely free. The next undervalued dividend stock, we have UGI Corporation, down 27% over the last year. Over the last 10 years, we do see it down negative 17%. It is trailing towards that 52-week low with, again, a yield above 6%, a forward P below 9, and market cap sitting around $5 billion. In terms of dividend safety, 60 borderline safe. We can take a look at that. $5.18 billion. It is a mid-cap company. And in terms of taking a note of their recessionary metrics, while they did increase the dividend, they had average growth and they significantly outperformed the S&P, one of the best stocks during that period, returning negative 16, much better than the S&P's negative 55. Dividend growth, well, last May, more positive. They did at least keep up in line with inflation. And over the last 5 years and 20 years, looking very positive in my opinion, especially when you are looking at a yield of over 6%. And they are a dividend aristocrat. They've been increasing the dividends over the last 25 years or more, while paying a dividend for the last 139 without a reduction. In terms of dividend yield theory, well, a strong double undervaluation signal both on the yield and the 5-year average, and we do note much lower than the utilities of 15.9 sector PE. Now, with utilities, we tend to ignore the free cash flow, given the fact that it is a lot more volatile. So on the earnings, we want to see below 75, looking very positive for UGI Corporation. In fact, pretty much around 50% as a maximum over that period, 51 expected in 2024. In terms of the earnings per share, not massive growth, but again, do have realistic expectations on the utilities industry. Different companies, different sectors, you can have different expectations. Nonetheless, it has grown over the last 10 years, and we are expecting an increase into 2024. In terms of the sales growth, well, this is a cyclical business, hence why we see some years of double-digit growth, followed by double-digit negative growth, and so on. And when we look at it numerically, we can see a lot of peaks and troughs going from 8.3 billion to 8.9 in 2023. With utilities, again, don't be surprised if they do dilute your position over the longer period. This is essentially to fund portions of their growth expenditures. So again, not something we should be surprised about over the last 10 years. ROIC above 7.5% for utilities. They do pretty much hit that nearly every single year. 11% in 2022. Negative 5% in 2023 due to the fact that they did make a loss. But overall, historical performance not looking too bad for this industry. And in terms of the margins, they do struggle to keep consistency. We can see that it is very clear. We want above 18%. Really only 1 year they managed to achieve that. And given in 2023 they did make a loss with a negative operating margin, we can start to see why this stock has taken a plummeting. And we will factor this into our margin of safety percentage. Net debt to EBITDA, well, below 5.5, only 2019 did they ever pierce through that. Other than that, looking very healthy. 2024 expected to be around 4, so I would say there are no worries with that dividend safety based on this information we have run through today. So in terms of the intrinsic value for today's episode, it is the average of these two models coming to $34. Again, with the utilities, with the way this company has performed over the last 12 months, you may want a much higher margin of safety. At 10%, it is a buy up to $31, 15% up to $29, and we keep going till we can see roughly the current trading price. And at 30%, it isn't quite there yet. So we see a fairly high 25 to 30% MOS level for UGI Corporation. In terms of Wall Street, well, they see 29% upside. Again, a very strong buy now from them with a price target of $32 over that period. We then move on to the next company, which is General Mills. Now, they are down 19% over the last year. Over the last 10 years, however, up 37%. We do see all-time highs just last year, in fact, at $91. They are trading towards their 52-week low with a yield of 3.42% and a forward P sitting at 15.31. Dividend safety, well, a very safe score of 90. Market cap 39 billion. We have a large cap company. And in terms of metrics, they've increased their dividend during the last recession. They had flat sales, but remember that was above the S&P, and they performed very strongly, similar to UGI at -12 versus the S&P. In terms of dividend growth, well, last summer 9.3%, so nice to note some very strong increases to their dividend. Over the last 5 years, very poor though at 2%. Over the last 20, looking a little better at that high single-digit number. Now, they have only been increasing the dividends for the last 3 years, but this is a company that has been paying a dividend for the last 125 years without a reduction. In terms of looking at dividend yield theory, well, we do note here reasonable valuation on the yield with a small sign of undervaluation on the forward PE. In terms of the consumer staples, though, that does sector PE sit higher at 20.2. Now, when we take a look at essentially the free cash flow payout, no worries for those that use 70% for consumer staples. 2024 is in fact expected to go lower, so I wouldn't be surprised if this summer we do see a 10 to 11% increase to their dividend. Free cash flow per share, not inconsistent, but it does increase over the longer term, just not massive growth, so don't be surprised if it is very marginal year on year. 4.74, however, a nicer increase expected into the next year's accounts. In terms of sales growth, well, 3 to 7%, pretty much what they have been hitting over the last 6 years. Again, they did go through 3 years of negative growth, so overall this isn't a company that is increasing their top line at a very fast rate, and that can easily be shown by looking at these sales over the longer period. In terms of shares outstanding, well, we see they've done share buybacks, they've also issued shares. Net position, though, they have bought back some shares over the last 10 years. ROIC consistently above that 12% that we see. 2023 at 13%, so you know what you're getting with this company in terms of some of their metrics. Very, very consistent, and the same can be said for both operating margin, which does sit at a minimum at that 16% level, and the free cash flow margin, which actually sits above that year on year. In terms of the net debt to EBITDA, below that 4 that we see for consumer staples, hence why we are seeing a very safe dividend score. 2.8 expected in 2024, and it is what it is this year. So lots of positives with this company, some things just to be wary of. And when we do look at that valuation in today's episode for General Mills, we can see it does conclude at $78.51. Now, in terms of the current price at just under $70, a 10% MOS level, we do see it pretty much there. It doesn't quite warrant a 15%. You'd need to buy around that $67 mark. So it is around that 10% mark as an MOS for estimates and judgments. In terms of Wall Street and their forecast, well, they see 11% upside over the next 12 months. They have a price target of $77. Similar to the other companies, they do believe this to be a buy. As always, do let us know your thoughts in the comments below. Have you been buying Bristol Myers, your Universal Corporation, UGI Corporation, or General Mills? Or are any of these sitting on your watch list waiting for a lower price? As always, if you've enjoyed the content, smash that like button, hit that subscribe and bell button so you are continually notified of these videos as they drop. And as always, we'll see you all on the next one.